Welcome back to the Onramp Webinar Series. In this edition of the show, we tackle the concept of Bitcoin as a revolutionary savings technology, which addresses the shortcomings of traditional currencies and other saving methods. Our speakers on this edition of the show include Jesse Myers, Onramp's co-founder, and Bram Kanstein, Onramp's head of growth. They discuss the problem at hand in terms of fiat debasement and the solution that is Bitcoin. The speakers discuss the inherent problems with fiat money, the mechanics of Bitcoin's supply and demand, and its potential valuation in the global asset landscape. They emphasize the importance of understanding Bitcoin's properties and the long-term outlook for its adoption as a store of value, as well as the migration of capital from other asset classes into Bitcoin. To stay up to date with everything that Onramp produces in terms of education and research, please be sure to sign up for the Onramp Research and Insights newsletter, which can be found on our homepage at onrampbitcoin.com. And if you'd like to learn more about our products or services and our approach to Bitcoin custody, please reach out to schedule a consultation with our team. Now, time for the show. Without further ado, I will kick it over to Bram first to elaborate a bit more on the problem at hand and why we think Bitcoin's an important part of the solution.
Yeah, thanks, Brian, and welcome everyone. I think, or we think it's good to start with the problem, right? Like we can think of a solution, but if we don't have a clear picture of the problem beforehand, then we also think that the solution that we obviously think is Bitcoin will land a bit less. So yeah, what is the problem? I think Brian already mentioned it. Like if we think about saving, why do we actually save? What is the purpose of saving? And I think the discussions that we have here kind of revolves around certainty and uncertainty, right? So for everyone, the future is uncertain. We literally do not know how much time we have. And so within the limited or finite time that we all have in our lives, we expend energy either every day or every week, every month, which is basically our productivity, for which we get rewarded. But the reward that we use, which represents, in an abstract way, our productivity or that energy and time, which we call fiat money, is kind of corrupted in a sense, right? Because we can create that money. That money can be created infinitely. So we basically trade our most finite asset of our time and our energy and time for a reward that can infinitely be created. Now, that doesn't really sound like a good trade, but we all basically do it. But what is the effect of that? Well, because we all don't really know how much time we have in our lives, we all have some sort of anxiety or insecurity about the future. There is a level of risk towards the future because we don't know how much time we have. So the uncertainty that we have, we basically want to mitigate that. And we were able in the past, or our parents or our grandparents were able in the past, to just gather more units of a currency, which we call saving, right? To kind of lower that uncertainty towards the future, so they could build some capital to eventually spend that on, whatever they wanted to spend that on in their life, whether it was starting a family or buying a house or moving somewhere, or, whatever they wanted to spend it on. But we can still, gather more units of the currency that's used in your country. But because of the monetary debasement, each unit is devalued over time, which actually increases the uncertainty towards your future. So that is basically the problem that kind of our thesis also around Bitcoin revolves around, because we think, and Jesse will elaborate on that Bitcoin is the ultimate savings technology. Bitcoin is kept in supply, as Brian said. That is also the entire point of Bitcoin, is that its monetary rules that are captured in the computer code basically are continuously checked every 10 minutes. We check the entire ledger. We check if the code is still running, and we say, okay, this can still go on, which basically the output of Bitcoin is certainty, the certainty that it stays the same as long as its protocol is running. And so what we believe is that if you use Bitcoin as the savings technology, so basically you can choose to get rewarded in Bitcoin for, spending your energy and time, or you can turn the fiat money that you get as a reward into Bitcoin and help you yourself and your family and your progeny, to lower the uncertainty towards the future, which will actually eventually give you the time and space to build, buy whatever you want. So whatever that is, whether that's a family or a home, etc. So we see Bitcoin as a superior savings technology, which eventually helps anyone who adopts it lower the uncertainty towards their future, which frees up the space and time to build out their life, basically. Yeah, I think that's a short intro. I'm not sure if Jesse has anything to add.
No, yeah, that's that's the right framework to think about what we're going to talk about here. Because what, and we say the ultimate savings technology. What is savings really? It's propagating your value today into the future so that you can use it at a future date, and doing that in a manner that has high certainty that it will propagate safely through time is paramount. And because of the properties of Bitcoin, we believe that it not only does it in a higher certainty way than any other asset out there, but because of its properties, it has a more attractive uplift to the purchasing power of that savings over time as well. And so I guess that's a good place to tee up the slides that we will be getting into here. At Onramp, we believe that Bitcoin is the most important asset of the 21st century. The hard part is securing it right. There are shortcomings with keeping your coins on an exchange, but also with setting up your own self-custody arrangement. Onramp solves for these concerns. Our multi-institution custody solution maximizes security and minimizes counterparty risk, ensuring that your Bitcoin remains securely in your possession, and provides built-in inheritance planning to ensure your family is protected as well. Onramp provides peace of mind for your Bitcoin journey, whether for your whole stack or for part of it as a complement to your existing self-custody setup. For more information, check us out at onrampbitcoin.com.
Maybe before Jesse starts, I had to think of one of the insights that really helped me in my journey is, and that ties into what you said, Jesse. So if you want to save towards the future and eventually spend that basically monetary energy on something else, once I realized that everything that we have, so if you're sitting behind your screen right now and you look around wherever you are, like everything you see costs energy to create or maintain. And so if you eventually see money as a reward for your energy, but also as like a tool to eventually spend on energy again in the future, as everything is uses energy to be created or be maintained, realizing that fiat money as a tool to do that basically loses energy every year. And that is, I think, again, the core of the problem, but also, as Jesse will show, the magic of Bitcoin in the sense that it cannot leak that energy. Over time, actually, more people will store more energy into Bitcoin as a tool for that. So I think that's what Jesse's going to show.
Yeah, and Jesse, before you jump into the slides, just wanted to mention to the audience, if you have any questions during the presentation about things we're talking about or anything else related to Bitcoin, please submit them in the Q&A chat, and we will get to as many of them as possible.
Yeah, our goal here is the back half of this will be a conversation based on your questions and hot topics. So please submit those. Okay, so sort of two topics here that we'll dig into is Bitcoin's full potential valuation, and that's this report that I put together almost 2 years ago now, and then as part of that, and these are kind of interconnected, the savings technology mechanics of Bitcoin and how those go hand in hand with Bitcoin's full potential valuation and where this thing is headed. As of now, Bitcoin has been the best performing asset of the last 15 years. And so it feels like you missed it, right? It's over, it's done, it's already become what it's going to become. And it feels like there's no opportunity left with Bitcoin. But all of this performance and Bitcoin being the best performing asset most years has gotten us to here. So Bitcoin is still only 0.2% of the world's assets. It's now a $2 trillion asset class. And that is in this $900 trillion global asset ocean. So it's still a very small bucket here. And this was kind of the important jumping off point for figuring out what is Bitcoin's full potential valuation. How big, how much of the pie, how much of this picture can Bitcoin eventually eat? And that's kind of the starting question for that line of inquiry. And the full details of the analysis and methodology are available on Onramp's website, and that link points you to where it can be downloaded. Brian, if you could actually add that to the chat, maybe that would be helpful for everyone. So the core of this analysis is that at all those different buckets that we saw on that graphic, they're all value. They're all value stored in different assets in the world. And because of Bitcoin's properties, and that's what we'll dig into in the second half here, I believe, and we believe, that value will migrate, will be siphoned off, will osmotically flow from those buckets to Bitcoin because it has more attractive properties as a store of value asset and as an investment asset than any of the other buckets out there. And so I went through the exercise of, in my opinion, somewhat conservatively assessing, all right, of the capital sitting in the buckets that were outlined in that overview of global asset value, what percentage of the capital stored in those buckets might be interested in shifting from that bucket that it's currently in to Bitcoin because of its superior properties, as the individuals and companies who hold those assets learn about Bitcoin. Because the reality of it is that 99.9% of the world doesn't understand anything more than the very surface level of Bitcoin. And it takes some learning and some time to understand the properties underneath that are very compelling and make it, in my opinion, the most attractive asset in the world to hold. And so going through that exercise, personally, I kind of put out some rather conservative numbers, in my view, about what percent of the capital in those buckets would flow towards Bitcoin. And you can see my Bitcoin capture numbers here. And when I summed all those up, came out to $200 trillion of the $900 trillion of value in today's dollars. And that would mean $10 million per Bitcoin in today's dollars, which would be 100x in real terms from today. And so I think that for me, that's the quick summary of the report of that's what I think is Bitcoin's full potential valuation. And this framework was also adopted by Michael Saylor. So he found this approach to establishing what Bitcoin could become in the global asset landscape compelling. And he used, in my report, I recommended running your own analysis, using this sort of framework, and deciding for yourself what percentage of those different buckets Bitcoin could capture. And so in the bottom left, that is Michael Saylor's version of what he thinks Bitcoin can do. And based on his numbers, he came out, one important difference is he includes inflation in his numbers, whereas I did everything in today's dollars. So you can see in the bottom right, his global asset value landscape grows 4x over the next 20 years because of that inflation. But his numbers come out to his base case is a $13 million per Bitcoin valuation in 21 years, which would be 140x from today. And so I guess my one point to make is I recommend you take a look at that report and think through it for yourself. And like this table in the bottom left, come up with your version of what percentage of value sitting in the existing buckets might migrate to Bitcoin in order to come up with your full potential valuation. It's not to say that that is what Bitcoin will do, but what's the scale of what digital capital could be in a world of $900 trillion of analog physical capital. So that's my numbers on what Bitcoin can become. And now that doesn't really make sense out of the context of the mechanics of Bitcoin and how it has gotten to where it is today, and why I believe it will continue to attract capital from other buckets. And the answer to those questions, to those topics, is Bitcoin's savings technology mechanics. So we'll breeze through this, but it's worth understanding what it is about Bitcoin that makes capital drawn to it and why that will likely continue into the future. So for me, everything that's special about Bitcoin as a store of value asset comes back to its supply expression, its supply function. How do you go from 0 Bitcoin in existence on day one to eventually a 21 million Bitcoin hard cap in the future? And that supply expression is here on the left. This is Bitcoin's entire monetary policy. And what it comes down to is this concept of increasing scarcity of new supply issuance. And that's the table that we see on the right here of the block subsidy per 4-year era. And that's what this expression shows on the left. Every 4 years, the amount of new Bitcoin issued per block gets cut in half. And that's very special, and was never possible in the traditional asset landscape, because you can't do that with commodities. You can't say we're going to decrease the amount of gold produced from mining every year. It's just not possible. But it's possible in the digital landscape, where you can establish these rules and have a supply issuance schedule that's set in stone. And this is it. This is what it looks like in the Bitcoin protocol. This is that supply expression manifested as code. And by using the Bitcoin protocol, you are agreeing to this supply schedule. And all it takes for it to be enacted is new blocks being found. And that's the entire incentive structure of Bitcoin mining. And that's how Bitcoin works. So the blocks will be mined, and then halvings will be triggered, and then new supply issuance will decrease over time. And that's what this chart shows. This is where we are currently in the supply issuance of Bitcoin. We just had the 2024 halving about 8 months ago now. And the existing supply of Bitcoin is this asymptotic line going up and to the right, which is approaching that flat line of 21 million. There will only ever be 21 million Bitcoin. And the gold bars here show the Bitcoin released per block. So the newly issued Bitcoin per block, starting at 50 Bitcoin per block. And you can see that exponential decay down to 0 eventually over time. So this is, Bitcoin's supply issuance is increasing scarcity of new supply issuance, terminating in absolute scarcity. There will never be more Bitcoin created beyond 21 million. And this moment in time is pretty special too, because this halving means that we have dipped below gold's annual supply growth historical average of 1.5% per year. And so now we are down. Now Bitcoin is a harder asset to make more of than gold. And that, in my view, lends it to being a better store of value asset that should attract more capital over time to park in that store of value asset, because it has this smaller dilution per year effect. So to take a step back a little bit and kind of take this to the abstract, I think this is a helpful way of thinking about how Bitcoin's supply issuance schedule is special. So this is your classic Marshall Cross, your Econ 101 stuff, where this is your supply curve and your demand curve, and price is set where they meet. But Bitcoin is different. Bitcoin has a completely inelastic supply curve, meaning that no matter how much people want Bitcoin, Bitcoin is pre-programmed to release a set amount of it every 4 years, based on the supply issuance per block and that table progressing through time. So in theory here, supply and demand meet at that price point, but then the next halving comes along and half as much supply is being issued per block. And you can see how that change in the supply issuance amounts to the intersection of supply and demand now going up on the y-axis, which is price. And that process continues. So the next halving reduces supply issuance again, and you can see how that might impact where price is set because of where supply and demand meet. A different lens of the same idea here is this is where we were at right before the halving, based on the market price of Bitcoin at the halving, and the price had been going sideways for a few months before that. We had been mining $1.8 billion of new Bitcoin every month in the 30 days before the halving. And because the price had been going sideways, there's a lot of noise here. There's a lot of external variables, but in theory, there had to have been $1.8 billion of net inflowing demand for the price of Bitcoin to be going sideways at that point in time. It had to absorb the new supply issuance, and that's what was happening. Then the halving comes along, and suddenly half as much new supply is being created per month, dropping that down to $900 million at the prices at the time of the halving. But ostensibly, there's still $1.8 billion of demand flowing into the market every month, because that wouldn't change. Of course, it does because of noise, but on average, you would expect the same sort of net interest in Bitcoin and accumulation of Bitcoin to be occurring. So this is what happened. This is what the halving triggered, which is a $900 million shortage per month, and over time that accumulates. So a quick walkthrough of those mechanics is in my mental model of how the halving plays out over time to generate a post-halving bull market. So the prior slide that we saw was, the left half of it was the orange square here and the blue square being in balance for a month, and price goes sideways. But then the halving occurs. Now there's half as much new supply being created, but just as much demand. And the key here is this available for sale portion, because the full circle below is the full circulating supply of Bitcoin, but not all Bitcoin is available for sale at any given time. In fact, it seems to be a much smaller portion, something like 5%, based on, that's my assumption based on how much Bitcoin moves in an average month. And so that available for sale sets the price in the marketplace, because the marginal sale of Bitcoin is the price for all Bitcoin. And we'll see how the accumulation of this supply shortage impacts the available for sale bucket and how that impacts price. So the halving happens, nothing feels different. That supply shortage starts to accumulate, and you can see here 3 months worth of bytes out of the available for sale supply. And after 6 months of this, price starts to drift upwards. Suddenly there's a big chunk taken out of available for sale supply. Buyers need to raise their bids in order to find supply, because the low-hanging fruit has been eaten through here. that process of the price starting to drift upwards does an interesting thing with Bitcoin where people get excited. And now there's more demand coming into Bitcoin because market participants, and especially people who've been sitting on the sidelines, see the price of Bitcoin rising and they want in. So now demand increases and the imbalance between new supply issuance and inflowing demand increases. And now you're starting to eat through chunks of available for sale supply at a greater clip. Granted, you're also inspiring holders, long-term holders, to start selling as well. But this process keeps playing out, and 12 months after the halving, you have a real shortage, and net inflowing demand has continued to grow. And now you're starting to look at the conditions of mania. So this process naturally flywheels. What starts out as a very small supply shortage per day, over 12 months has flywheeled into a mania where there's more and more demand coming in, and the price starts to run, and that causes a bubble. And so the mania flywheels into a bubble, and that bubble pops. But on the back end of that, on the back end of that bubble, the changes that the halving had created are not undone. So the new supply issuance each day that the halving triggers is permanent and compounding. And so you don't undo the conditions that created that bubble, the halving, and that new supply issuance level. So you find equilibrium where you overextend in the run up of that bubble. That mania causes you to overextend what is equilibrium for that era of new supply issuance, and then the crash causes the opposite effect of it goes below where it probably should be based on supply demand price equilibrium. And then it spends the next couple of years finding equilibrium just in time for the next halving to set the process in motion again. So this phenomenon, this is my sort of mental model of how Bitcoin's price moves over time when shown on a log graph. And this obviously takes out all the noise and ignores the numbers on the axis just to show the mechanics of how I think this thing plays out over time. But this up and to the right trend of purchasing power amounts to a savings technology. And that's what's really special about Bitcoin. If you put value into Bitcoin today and you hold for more than 4 years, you will grow that purchasing power because of these mechanics playing out over time and adoption of this asset because of those mechanics. Also helping to lift the purchasing power of the Bitcoin that you hold today for 4+ years. And so then the question becomes, if Bitcoin's mechanics cause it to be a savings technology, how much of the world's value sitting in this $900 trillion global asset ocean will be interested in migrating from these assets like bonds or real estate or any of them into Bitcoin as individuals and companies and nation states learn about the properties of Bitcoin as a savings technology. So that's where I wanted to leave that conversation, and I guess I'll open it up to Bram for any additional thoughts or commentary there, and then we can get into Q&A.
Yeah, so I think what's good to add is that, sometimes it might sound like people see Bitcoin as an investment, right? You could perhaps even draw that conclusion from what Jesse just shared, but I think it's better to see it as moving your economic energy that we talked about in the beginning, basically to a different monetary system. That's also why we call it a savings technology, right? We focus on the long-term preservation of the purchasing power that we acquire right now with, again, the productivity that we expend in any amount of time. So that's also, I think, part of understanding Bitcoin is, from the paradigm that we live in, it might be quick and dirty to look at it as an investment, but over the longer time, we see it as a totally different monetary system and a better savings technology, as we mentioned. I think maybe Jesse, if you can show the slide of the future slide of this one with the blocks, because I think one thing to add there, which is important, is that sometimes when people talk about Bitcoin, it's like, oh, the dollar is going to fail, or all the fiat money is going to fail, etc. I think what this example greatly shows, let's say the bottom right one of Saylor, is that it's more about, as Jesse also alluded to, it's kind of moving around and kind of like getting store of value dollars, basically, that have now been put into real estate or art or collectibles, whatever, moving to Bitcoin. So even when we get to the base case of Saylor in the middle, I think it's a honey badger, right? The 13 million per Bitcoin. That doesn't mean the world breaks or the legacy financial system breaks. I think that's a good point to further iterate. And this is a great illustration, I think, that shows that. So in order for Bitcoin to succeed as a superior savings technology, that does not mean that all the fiat money dies or we go into some terrible chaos or something like that. So currently, some people will trade it. They do see it as an investment. I think we are proponents of a buy and hold strategy with a long enough time horizon. And like these boom bust cycles that Jesse showed is basically human psychology. We do not have the so-called HODL waves in this presentation, but I think just from the top of my head, probably like 60+% of all the Bitcoin in circulation has not moved in 3 years. I think I can say that, but Jesse, correct me if I'm wrong. But so the people that hold this, they understand what this is and they have a long-term outlook. And so the Bitcoin that's actually actively traded, that's actively leveraged, with sometimes we see these flushes or shoots up or down. That's actually not a lot of Bitcoin that's involved there. So that trading market is smaller than the amount of Bitcoin that's being held by long-term holders. And I think we also see, but I'd love to get your thoughts on that, Jesse, that the possibility that the time of minus 80% drawdowns could be behind us as more and more capital finds its way into Bitcoin, also with this longer term outlook. And so that means, once this asset class grows, more capital is also needed to go either go up or down. And so, I personally think that these bigger drawdowns are behind us. But again, that's just human psychology of plus understanding of people that, do gamble with it in terms of leverage and stuff like that. Last point. As we see in these blocks, right, we really talk about store of value. In original white paper of Bitcoin, it's called peer-to-peer electronic cash. Eventually, we can see Bitcoin moving to becoming a medium of exchange, so people exchanging Bitcoin for goods and services. And actually, today I saw a really great tweet about it. I'll quickly look it up here. It's very important to understand that store of value comes before medium of exchange, right? So if I cannot save with this new type of asset, why would I ask it for or as a reward for the work that I'm doing or the products or services that I'm selling? So store of value comes before medium of exchange, and that might take some time already, as we can also see in these graphs. Like this will not happen within the next year or 2 years. The outlook of Michael Saylor is 2045 in order to get to that 13 million Bitcoin price. So I thought that would be an important addition to make, as it might be confusing, hearing people discuss Bitcoin saying, well, I cannot buy a cup of coffee with it. The entire point is that we first establish it as a store of value before it can even become a medium of exchange.
Yeah, that's a great point to highlight here, that when I put out the full potential valuation piece, I was I didn't put a timeline on it. I said decades, and because I think that's the right way to think about where Bitcoin is at in its life cycle and its development. It is very early in the S curve of monetization, in my opinion, and that's Bitcoin becoming a store of value for the world.
Yeah,
I think right now Bitcoin is viewed as a store of value, as the preferred store of value asset in the world by a very tiny bunch of people that we call Bitcoiners. And that's a contrarian group at this point, truly small in the grand scheme of things. Maybe 1 million people, as Bram and I have talked about. Maybe it's 100,000 people really in the world who understand Bitcoin as the best store of value asset to be holding. And if Bitcoin's properties are what we talked through, and I think they are, the world will eventually wake up to those properties and discover, wait a second, this internet money, this monopoly money online that doesn't have any intrinsic value, is the best store of value asset in history, and I want to hold that. And so I think we're if you think about the S curve of monetization of Bitcoin's total value over time, we haven't really reached that hockey stick yet. But I think that's coming as we make our way through the bell curve of technology adopters, and the bulk of those individuals are in the center of the bell curve. And as we kind of progress into that bell curve, we'll see larger and larger cohorts of new adopters come in with bigger chunks of capital per year than we have seen. And that will, I think, rapidly scale. That'll be the fast part of the S curve of Bitcoin's monetization. And again, this is all in the context of Bitcoin becoming the store of value for more and more people in the world. And the step after that is once a large portion of the world views Bitcoin as a valid store of value asset, then you can start to price goods and exchange value in that medium of exchange. Because people want to settle in Bitcoin as a store of value, then you can conduct trade in that medium of exchange, and all the infrastructure that is being built on layer 2, on Lightning and whatnot for that transactional future. But what we're focusing on here, and what I think the investment opportunity is for individuals with Bitcoin, is because we are early in the store of value monetization phase of Bitcoin.
Yeah, a few things to add to that. I think the long-term outlook is perhaps difficult for some people, but I want to remind everyone that Bitcoin is basically taking on the biggest topic in the world, right? It's money. It's how we exchange value with each other. So the fact that it has already survived 15 years and we are in the midst of this monetization period, the fact that there are countries using government resources to mine Bitcoin, the fact that multiple presidential candidates in the US have taken Bitcoin as an important subject. There was a Treasury report this week that put Bitcoin or defined Bitcoin as digital gold. You see the path opening, but the path is still long. But we have seen this in the past, right? So this is nothing new. Currencies come and go, but also what Jesse said, eventually the moving to a medium of exchange. There are several examples of stores, even in Canada, taking on US dollars and giving Canadian dollars in return. I spoke to someone last week who mentioned that in the Eastern Caribbean, you have the Eastern Caribbean dollar. People take US dollars, they give the weaker currency, the Eastern Caribbean dollar, back. So we can also imagine a time where there will be a dual pricing in our economy for the people that understand that Bitcoin is a better reward for whatever they are selling. Perhaps you will get a discount if you pay in Bitcoin, but then you will also get a weaker currency like the US dollar, for example, in return. And the last point I wanted to add, sometimes we hear critics mention this, intrinsic value. I think there's a whole that's a whole different discussion even to talk about what is value and then definitely what is intrinsic value. But I wanted to share read a tweet that I saw yesterday, which I think illustrates it well, right? We mentioned that, what does Bitcoin produce? It produces the certainty that basically stays the same. But what is this ledger of Bitcoin? And this was the tweet that said, all data must live on a ledger in order to record truth for dissemination. The Bitcoin network is the first time in human history the ledgers are incorruptible, immutable, and publicly audited every 10 minutes. And this is basically what the product of Bitcoin is. It's not only that certainty that it stays the same, but all the information in the Bitcoin network is basically the pure truth of that system. And if this system is a monetary system, then we can basically conclude that, this is the best money. It's the fairest money, right? If we talk about the dollar, which is the best currency of all the currencies, we don't know how many dollars there are in supply. The Federal Reserve has never been audited. Just two simple examples that are just a total 180 of Bitcoin. And anyone can verify that for themselves. That's also the entire point. If you listen to us talking about Bitcoin or anyone talking about Bitcoin, I think we always share, you should study Bitcoin yourself, and you don't even have to believe us or anyone else. You can basically verify it for yourself. And that is part of the core of the value of Bitcoin as well, that you are in total control of judging whether this is what it says it is.
Does your Bitcoin custody setup keep you up at night? Maybe you still have coins sitting on an exchange worried about hackers. Or maybe you've set up your own self-custody but don't feel safe with your Bitcoin savings stashed on a little plastic device in your desk drawer. Gain peace of mind with Onramp and our multi-institution custody solution. Here's how it works. Onramp creates a dedicated multi-sig vault just for you. 3 separate institutions each hold a key: Onramp, BitGo, and CoinCover. But none can move funds unilaterally. Instead, only you have control over your coins. With Onramp's multi-institution custody, you'll sleep better at night knowing your Bitcoin is stored with best-in-class security on-chain with fault-tolerant multi-sig. If you believe your Bitcoin is going to be worth a lot someday, don't jeopardize that future by exposing your coins to hackers on exchanges, $5 wrench attacks in the real world, or perhaps most importantly, the risk that you might screw something up with a highly technical self-custody setup. Onramp's multi-institution custody eliminates single points of failure, reduces your personal attack surface and technical burden, and provides access to financial services that allow you to confidently secure your Bitcoin, including inheritance planning, insurance-backed warranties for all balances and transactions, low-cost trading, and more. Bitcoin is a once-in-a-species asset. Secure it right. Learn more at onrampbitcoin.com.
Very well said, both of you. I think one question that comes to mind, and really for both of you, is this idea or this concept of a monetary premium, I think is important to elaborate on. So most of those other asset buckets, which you've shown on that global asset landscape page, Jesse, are not valued purely on their utility value per se. And so there's some amount of monetary premium associated with all these other assets. And so in your mind, do you have a sense for which particular asset buckets are most likely to cede ground to Bitcoin over time? Are there any that are more likely in your mind? I think, I've heard arguments for real estate or bonds in particular as being, the most likely areas where we'd see capital flow, really that monetary premium flow or erode out of those asset buckets and into Bitcoin. But any thoughts around that?
Yes. It's really interesting and fun topic. I think that, so I guess part of the full potential valuation report is establishing that all the value in the world is relevant, meaning that when people buy an asset, they're buying that asset because they're trying to propagate their value into the future and hopefully grow that purchasing power over time. And that's true of anybody allocating any amount of their portfolio. That's constantly the question that's being asked, which means that any value in the world is relevant to what Bitcoin can take. or where Bitcoin can siphon off from. And then of those buckets out there, the ones that I think are most likely to have outflows that point towards Bitcoin, bonds is the number one for me by a lot. And I think that the important thing to consider there is, what is the value proposition of bonds to a buyer, to a holder of bonds? Well, that is, okay, you will park dollars here today and you will receive a 4% per year nominal yield. And that's your reward for tying up your capital. And the idea there is that that should outpace the 3% CPI inflation we believe we have. But I think inflation is higher than the CPI numbers state. I think there's every incentive in the world to massage those numbers down, and I think they do that. I think a better barometer of true inflation is the growth of the money supply over time, which has been averaging, M2 money supply growth has been averaging 7% a year, and has been increasing over time. That rate of growth has been increasing. So Saylor in this model, in his model, assumes 7% continues into the future for inflation. I think that's right at minimum. I think it could be higher than that. And so if you're holding bonds generating a 4% nominal return, but inflation 7%, you're destroying 3% of your value every year that you hold your bonds. And so that's a burning platform. So there's $300 trillion of capital in the world that is sitting in an asset that looks like it's growing your value over time, but I think is actually destroying value in real purchasing power terms every year that you hold it. So as bondholders wake up to that, they have the greatest incentive to get the hell out of bonds and go to an asset that provides a similar utility, a similar value proposition. Park your money here today, grow it over time. But it does it with different mechanics and has a much better performance because of its endogenous properties and also where it is in an early stage in its adoption curve as a financial asset. And that's Bitcoin. So I think that Bitcoin becomes the 21st century substitute for bonds in a portfolio if an investor wakes up enough or does their homework enough to understand, here's what bonds do, here's what Bitcoin does, but it does it way better. And so maybe I should sell my bonds and buy more Bitcoin. So in my calculations, I said only 30% of the capital stored in bonds will migrate to Bitcoin, but I think that the number could actually be much higher than that. It could be 90% even. That wouldn't actually surprise me because there's no utility to holding bonds as an asset. It's purely a store of value and investment value proposition. So all of that capital should be interested in migrating to an asset that fulfills the same value proposition but does it much better.
Maybe
the interesting.
Oh, go ahead, Bram.
No, I think the interesting thing here is that because and I think the 7% is a good percentage to calculate with, right? I think it's somewhat conservative, but I think it's good enough. Yeah, like if you have a 10-year bond, and that rate is lower than 7%, then you basically also lose money, right? So,
yep.
In some ways, and I mean, if you study a little bit, you sometimes see like, okay, well, nominally, I will get a certain amount of dollars, so that seems like more than what I put in. But over 10 years, 7% a year is more than half. A loss of more than half of the purchasing power of those same dollars, and that is what you need to take into account there. The difference with Bitcoin, right? Because we talk about this debasement, where does that come from? It comes from the inflation of the money supply, which debases the value of the existing supply, which eventually inflates, all the prices that we see. And so one of the kind of like memes or topics, talking points that people have in Bitcoin is that they say 1 Bitcoin equals 1 Bitcoin. The 1 Bitcoin now is the same Bitcoin as in 10 years because the supply of Bitcoin cannot be diluted. But the $1 now in 10 years will not be $1, right? It will be like 42 cents or something like that. So I think once you approach it like that and integrate that into your calculations of, okay, where do I store the money that I have right now? You can store it within the paradigm of all the fiat money with all the instruments that are also there, or you move it to this newer paradigm that basically promises and shows you in a way that you can verify yourself that it's not being debased as happens in the older paradigm. And so even having a small percentage of whatever you want to park or save somewhere already, if you take, let's say, the 10-year example, already gives you a lot of return, even with conservative numbers.
I think now is probably a great time to dip into some of the questions that we have in the chat here. I see this recent one from Stanley asking if we're talking about the $2 trillion in Bitcoin and the $900 trillion asset landscape, what about the other digital assets that amount to $1.6 trillion on top of that? Where do they belong? And why does this view exclude them? Funny enough, if anything, that maybe they should be included in equities. My view is that the other digital assets out there, other cryptocurrencies, are largely, if not entirely, unlicensed securities. They're really companies. They're venture companies masquerading as a currency. And so my view is that Bitcoin is different. It is the invention of digital scarcity. It is the invention of digital capital. And it's the only real it has won the store of value use case for digital assets. And in my opinion, that's 95% plus of the value of digital assets is to have a digital store of value asset. And so I think that over time, Bitcoin grows based on that value proposition and that use case. And other cryptocurrencies remain a sideshow and shrink in relative scale compared to Bitcoin as Bitcoin continues to monetize and grow much larger. I don't think crypto beyond Bitcoin will keep up. So that's my view on that. We can
maybe I'll combine a few here that
great.
we have in the chat. Really, talking somewhat about cycle positioning. Where are we in terms of this current bull run? And one of the questions is around, should people be tempted to take profits off the table during a bull run in order to redeploy that in the next bear market? And then alongside that, a question around on-chain metrics. Is there any particular metrics that you guys focus on to get a sense of where we are in the cycle?
I'll answer that last part first. Of on-chain metrics, I think they're very interesting, and there's probably some value in there. The last time that I tried to trade Bitcoin, I got burned because I paid too much attention to a particular on-chain metric that had incredible fidelity of back testing. If you look back in time, it was NVT signal, which was being popularized by Willy Woo 4 years ago. And I got burned by that. And I ended up with, if I had not dabbled in that, I would have 10% more Bitcoin than I do. So, and that was an on-chain metric. And it was the darling of the era. And it ended up predicting that we were going lower, and we didn't. That was the very bottom. And I got caught on the sideline, and I regret it. So that's my take on on-chain metrics, is that they can be very interesting, and there probably is some information, actionable information in there, but there's so much other noise or contrasting information, information that would point you in the wrong direction, that my take is you're better off buy and holding than acting on-chain signals to trade.
I would agree with that. One thing to add, part of the way I think about it is all on-chain metrics are, of course, backward-looking. So I don't necessarily put predictive power in on-chain metrics, but it can be helpful in getting a sense of, where we are in terms of, historically during bull runs, you start to see long-term holders distribute coins. It's happened every time. It'll happen again this time in terms of people taking profits who have a very low cost basis. And so seeing that on chain, I do think is actually helpful in terms of getting a grasp for where we are in the bull run. The most recent data I've seen on this is, we're not anywhere near sort of overheated levels in terms of that long-term holder sell pressure. You're starting to see it here and there, but we're still, I would say, early innings in terms of some of those metrics. But like I said at the beginning, I don't think there's predictive power necessarily in these because the future can always change. We have a new class of buyers that are now in this market, which I think is important to consider. Harkening back to what Bram was suggesting around, well, are we going to have another 80% drawdown? My thinking is, it'll probably be less severe than that, just because we have new market participants that are looking for a better entry, and so there's a lot of capital on the sidelines that is now, looking through to a new administration, better regulatory environment, and saying, when I get a chance to buy this thing in mass, I'm going to do it. So there could be just larger, more sophisticated dip buyers, effectively, as the next couple of years plays out. So that's another thing to consider, that the future is not necessarily going to be indicative or look like it did in the past. But Bram, did you have any other thoughts there?
Yeah, I think it's an interesting question. I will. Which question were you referring to? I'll share in the chat. I could type an answer. I found.
There was a few that we were speaking to just around cycle positioning and on-chain metrics.
Yeah, I'll type an answer here to Patrick. I think that would be public. There's a guy on Twitter called The Rational Root, who I think has an interesting model where he kind of follows these, you probably know, like this classical graph of like, what's that called? Like despair, hope, etc. Euphoria, we go up and down, etc. But he made it into like a circle, which I think is an interesting angle. But again, I think to Brian's point, it's all backward looking. And it's good to consider that we are going through, as Jesse mentioned before, the monetization phase of a totally new asset that, at least to our understanding, based on information that anyone can study, is superior to any other store of value asset that's currently out there that people are using. So, I mean, the fact that we are going through this phase, I think, is an added dimension which makes it harder to trade it. Jesse maybe knows this better, but there's probably in the last cycle, there's like 10 days where you could have made the most amount of money if you paid attention as a trader. Overall, for the general person, once you understand that having the long-term outlook is the best, you will just buy and hold. I always say, I bought at 300, I sold everything at 4,000. Which at that time I felt great, but now I have less Bitcoin than before. This is 10 years ago, right? 10 years ago. Over time, thinking about that use case of lowering your uncertainty towards the future, acquiring this asset to create capital to build whatever you want to build in the future. Once you look at it at it from that viewpoint, at least personally, but I think the guys here can attest to that, like the trading questions or fears and stuff kind of disappear, because then it becomes more about accumulating more of this thing and doing your best in the fiat world or however you make money in order to acquire more of this asset. So I think, we can share our thoughts around these questions. But I think they're mainly geared towards, okay, like how do I trade? And notoriously, trading has been difficult if you're not a, professional day trader, basically. Like trying to time the market is very hard. And I've also been burned quite a few times in that. So
every time I've tried to do anything fancy, I get burned. So
Yes.
buy and hold is the winning strategy. And that's because the volatility with Bitcoin is to the upside, meaning that you got your down days, you got your up days, and then every so often there's a plus 5-10% day. And it catches everybody by surprise. It comes out of nowhere. And you better have been holding. Otherwise you missed out on that. And that's that's what really moves Bitcoin over time is, 10 days like that a year is where all the gains happen.
Yeah.
And you want to be holding to enjoy that. There's a question from Michael here about given the transition to a new type of buyer, more sophisticated investors and nation states, do you still expect large boom bust cycles that we've experienced before? So my mental model for that, even though we just talked about how unactionable market cycles may be for trying to time the top and trade, my mental model is that we will continue to see what we've seen, which is actually a decreasing drawdown over each subsequent cycle. I think the first bear market for Bitcoin was like a 91% drawdown, back in like 2012. And then 85%, and then 80%. And then I think the most recent one was like 75%. And I think that trend will probably continue. And I think that's the maturation of an asset over time. And part of that is the increasing confidence of the market that, okay, if you're experiencing a strong downturn, that's a buying opportunity because this thing keeps coming back. And also that, as this asset matures, you start to view it as a long-term asset that you're going to not be as moved to try to trade in and out of, or view as a short-term asset. So I think that trend continues. My sort of base case is we'll probably see like a 70% drawdown at some point. It is possible that the scale of these new market entrants changes that, and like MicroStrategy will be buying the dip in the next bear market. That you can be sure of. And does that mean we only see a 60% drawdown? That's possible. But my mental model for, until that is proven wrong, I will continue to believe we'll just see decreasing amplitude of drawdown each subsequent bear market.
Well said. We had a question around custody, which I think is worth elaborating on. So self-custody is really hard for those familiar with it, or even for those familiar with it. Will Bitcoin adoption accelerate rapidly when a customer-friendly solution is launched? Jesse, maybe you could speak to this, and also the realities around different custody models, the trade-offs, and also what we're building here at Onramp.
Yeah, absolutely. It's a great question, and I think it's the right question. I think that self-custody is really hard, even for those familiar with it, exactly as Johnny here stated. And I think that part of moving through the bell curve of adoption and getting into the mainstream of technology adopters is having more user-friendly solutions that don't sacrifice much at all. And I think that's what has to happen for a technology as it develops in order for adoption to happen with the mainstream. Mainstream individuals are not that tech savvy, or and I think self-custody as it exists may be more daunting than people in the middle of the bell curve are willing to take on. And so that's really where Onramp came from. So what we do at Onramp is multi-institution custody, which is a type of multi-sig custody, which provides the best security possible for an individual's Bitcoin, where they don't have to participate in the technical or security requirements of setting up and maintaining that custody arrangement. Instead, they're hiring the best companies in the world to act on their behalf as key holders in this 3-key multi-sig setup. So in Onramp's product, Onramp holds the key, BitGo holds the key, and coin cover holds the key in a 2 of 3 multi-sig setup, meaning that 2 of those keys need to sign any transaction for it to be processed. And so in that way, you have fault tolerance where 2 of 3, but not all 3 are required. So any one of those companies could go under or somehow lose that key, and the assets in that vault would be just fine because 2 of 3 is still there. And it also means that no key holding institution can unilaterally control the funds in that vault. Only the end user, the client, has the legal relationship directly with each of those 3 key holding institutions to authorize that institution to sign any transaction on their behalf. So in that way, this new form of this evolution of the multi-sig format is very attractive for removing a lot of the complexity and technical and security requirements from the end user and making it more accessible to the mainstream or the average adopter of Bitcoin to have their Bitcoin in an on-chain address that they control without having to figure out the technical and security requirements that are quite daunting for self-custody.
Yeah, it's really well said, and I think the question is well stated, and it's the right question to be asking, because I think, the reality to me at least is that the reason Bitcoin isn't a much larger asset already today is because of the difficulty of self-custody and also the peril of trusting a single counterparty. And so everything that we're doing at Onramp is trying to solve for exactly that, to abstract away the complexity of key management while still eliminating a single point of failure in a third-party custody setup. And in my view, that will allow us to just onboard far more people at a much faster rate than telling people that they need to take hours, potentially years to learn cryptographic security in order to adopt the asset, while also saying we recognize it's been a pretty poor decision to just trust one single counterparty unilaterally historically. Whether from Mt. Gox to FTX, there's countless examples of that going wrong. And so everything that we're doing is really trying to solve for exactly that and be able to more quickly and more securely onboard people to this asset. Okay, one other question I had going back to the asset buckets, Jesse. There's been a lot of conversation recently from the sailors of the world and also from people in government around the idea of selling gold in order to buy Bitcoin. So when you look at that bucket of gold, do you think that gold just gets demonetized by Bitcoin over the next couple decades? Or, I think there is also an argument on the other hand that because of, rampant inflation and fiat debasement, that there's a value prop for gold still in this world over the next couple of decades. So maybe you see gold sort of grind upwards in tandem with Bitcoin, but obviously at a much slower rate. Do you ascribe to either of those lines of thinking of, well, if all these nation states are going to sell their gold, then that could be pretty bad for the price of gold? But any thoughts there?
Yeah, I think that. I think you nailed it with one of your possible scenarios. I think that gold does well, but very interestingly, I think that gold underperforms Bitcoin significantly. So I think that what we've seen over the last 50 years. Well, I guess I'll start by saying Peter Thiel put out a great slide a couple years ago. I think it was 1981. Global equities were $1 trillion. I think it was $1 trillion, and gold was $1 trillion. All the gold in the world and all the equities in the world were the same value. And what we've seen since then is equities has 10x'd relative to gold, roughly. And then now gold is starting to catch up a little bit. And I think that gold has suffered in the fiat era as other assets have been monetized, and possibly the price suppression of gold from paper gold issued by central banks has played into that. But I think that the sovereign debt levels that we're currently facing will cause a flight to hard assets in general. I think there will be a major shift. I think this is going to be a prevailing trend for the coming decades of people shifting value from bonds and money and fiat money itself, which are two of the larger buckets on that page, which and those two assets are fiat money itself or contracts for future fiat money. And I think you're going to see a transition from those buckets back towards hard assets. And gold will do well because of that. But I think that Bitcoin will vastly outperform gold. So I think, while gold will grow and probably grow as a relative to other assets in the global asset landscape, Bitcoin's growth will probably order of magnitude outpace gold's relative growth. So, if you think about the hard asset category as Bitcoin plus gold, today that's like a $20 trillion asset class, roughly, 10% of which is Bitcoin. And I think we will, over the coming decades, see that flip where, 90% will be Bitcoin and 10% will be gold, even though gold grew relative to bonds and, the other traditional asset buckets.
Yeah, I think what I can add to that is that requires just a rational approach. I think there are two main arguments for gold. One is the narrative of gold. When you look at these overview charts of characteristics of gold and Bitcoin, for example, of course, gold has been used for over 5,000 plus years. That's mainly the only thing where it basically wins in terms of characteristics from Bitcoin. I think the other part that is not necessarily in kind of like these overviews like that is that, of course, central banks are still buying gold. So that helps in the narrative for gold. But if you just look at it in an objective way, I once heard someone say, if you want to move 100 million in gold, it will cost you 10 million. We can move 100 million of Bitcoin for $3, basically to anyone in the world without any counterparty risk, with final settlement, etc. And so, just wanted to add that as a little, tidbit, because I do believe there's a place for gold in the world. But I do believe it's part of the inflated asset classes, as Jesse just described. If you just look at the properties, Bitcoin has better characteristics. There is no fake Bitcoin, for example. You need like 3 machines to figure out if your gold bar is real. So there's like these pretty important things that I think show the benefits of Bitcoin there.
Maybe one question that sort of circles back to how we started the conversation around the problem at hand of inflation and fiat debasement. And could each of you talk a little bit about, why that is likely to persist? If we think about 36 trillion in debt in the United States, I think with the new administration coming in, there is at least reinvigorated sense of the government needs to be more efficient. And so that's on net a positive sort of development. But, even if they're able to rip out 2 trillion of, wasteful spending and sort of cut back on the deficits that we've been running, that 36 trillion still exists. So I think if each of you could talk about, just circling back to the problem at hand and why the fiat debasement will continue to persist over time, and why, Bitcoin as a sort of release valve for that persistent reality makes sense.
Yeah, maybe I was thinking maybe to quickly answer one more question that I saw in the chat from Nicholas. Before we talk about this, and I think eventually wrap it up. He says, as a software engineer, I know how the sausage is made. Can you speak to the code security vulnerabilities? Well, I think that's a wonderful question, right? Because we talk about, what is the promise of Bitcoin? What does it deliver us, right? Like it never changes. That's basically the premise. And because it never changes in the sense that one Bitcoin will always stay one Bitcoin, no one can change the code and say like, oh, there's going to be 100 million Bitcoin, right? That is, of course, the promise of stability that it gives. I think there's two things. Bitcoin is open source software, right? Anyone can copy this code. You can start Nicholas coin tomorrow. I can start Bram coin tomorrow with the same code as Bitcoin, and then make it maybe 100 million Bram coin units, for example. Why is that not happening? It's because Bitcoin has this network effect, right? So this code, or the proliferation of the code of the network, is basically secured by a growing amount of not only nodes that check the ledger, the blockchain of Bitcoin every 10 minutes, but also by miners that put electrical power towards the computers that are used to mine Bitcoin, which is, I think, at an all-time high, or almost at an all-time high, this computing power. And it's basically the most powerful computer network in the world. And it's also decentralized. And so if someone would want to change the code of Bitcoin, or, for example, double spend a certain amount of Bitcoin, or have control over the network for 10 or more minutes, the attack costs are, I think, just from the top of my head, probably like $10 to $15 billion to control this network for 10 minutes. So if you want to know how the sausage is made, you can actually look up the source code. You can go through the source code. This is software code that has been scrutinized for 15 years already. And I think what could help you in that assessment is understand that there are a lot of participants, or all the participants, the main participants in the network, the nodes and the miners, basically validate that this code is the right code that we are using. I don't know if the guys have anything to add, but that will be my quick answer to that question.
Yeah, the one small addition I'd make is, it's interesting that Bitcoin is this live experiment. There's $2 trillion in Bitcoin now. And if anybody could figure out how to break Bitcoin, they could win up to $2 trillion by shorting it, and then breaking Bitcoin. And so that incentive is always there, and has been there, and has been material for 15 years, and nobody's done it. In fact, everybody who's really taken a look under the hood has come away more certain that it is resilient, robust, and unbreakable. So that's the other way to think about it is everyone in the world has had an incentive to try to break it, to profit massively for 15 years, and has been completely unable to do it. So at what point does that speak to the sufficient security and strength of the network and the protocol? For me, that's enough. But maybe your individual threshold is higher, and maybe it takes 30 years before you're persuaded.
Yeah, good point. Brian, can you repeat the last question?
Yeah, just wanted to tie it back to how we started the conversation around the problem at hand, and why Bitcoin is a solution, and why, in particular, that problem is likely to persist. Right, the debt problem is not going away. The interest expense on the debt is only accelerating as we roll over some of that debt at higher interest rates. So just talk a bit about sort of why that's likely to persist, and why it's sort of imperative that people think about Bitcoin right now and today, and start figuring this out, because those problems are not going away.
Yeah, I think Jesse probably has a deeper answer to this, but I think I'll refer back to the path that I mentioned in the introduction, right? Like we have Lynn Alden in the Bitcoin space, who says this train ain't stopping, and she means the dollar debt train. And why do we talk about the dollar, right? It's the best of all the fiat currencies, but it's inherently flawed in the same way as all the fiat money systems that are used around the world, but it has the advantage of being the world reserve currency. I approach it like this. If anyone goes to the usdebtclock.org, you can see that the US debt is probably 36 trillion something. Per citizen, it's around 100,000 from the top of my head. Per taxpayer, it's 250,000 from the top of my head. So basically, Americans work 3 out of 5 days a week to pay tax on that income tax, to help their government pay interest on that outstanding debt. None of the principal, just the interest. So that doesn't go to any other things that the government can do. The yearly deficits are more than, or the interest payments yearly are more than the entire defense budget. I think there's a stat from history that once that happens, the end of that fiat money system is, or that's the beginning of the end of a fiat money system. But also, if you go to the usdebtclock.org and you go to the bottom right, you will see all the unfunded liabilities, which are like 220-ish trillion, which are basically all the promises made by the government that are set in law, like Medicare and pension and stuff like that. That's basically promised, but in essence, it's not there, right? Because it's unfunded. Like, that money is not there. And I think the simple case to be made is that, to add income or to create debt for the US government, they sell their treasuries. But yeah, what is the point at which the former buyers of those treasuries will realize that this debt will never be paid? Or if it's nominally paid back, then each unit of what is paid back will have lost significant value. So that will eventually lead to the US government printing their own money to buy, air quotes, to buy their own debt, which eventually, will be socialized in terms of inflation of prices for anyone and debasement of all the existing money units. So the train that's not stopping is, in my understanding, this. Which other people like James Lavish, for example, who talks a lot about the American debt, the US dollar debt spiral. It's basically accelerating. It's like you're paying off your credit card with a new credit card, but the interest rate and the total amount that you need gets higher and higher. So I think that is a good realization to understand that is the system that we are all in, and that we see Bitcoin as the lifeboat to kind of get out of that or protect yourself against that inevitable end result.
Yeah, you nailed it. I think that the unfunded liabilities thing is the real smoking gun that most people ignore. I mean, we talk about $36 trillion in debt, and I'm certainly guilty of this, but it's much bigger than that. If you account for the full obligations of the U.S. government into the future, it's much bigger than that. And yeah, I mean, we haven't balanced the budget in 22 years. We've normalized multi-trillion-dollar deficits. Now we have $1 trillion of interest expense because after a decade of zero interest rates, interest rates set at zero, now we have real interest rates again, and we got used to having debt for free. And now we have to pay for it. And now that's a $1 trillion expense that didn't exist 5 years ago, and will only add to our deficits. And again, we just entirely lack the political will, especially as an electorate. Think about the last time you heard on the news people talking about the importance of balancing the budget. It just doesn't happen anymore. It used to happen 15 years ago, but it doesn't anymore. So the political will to rein in spending and balance the budget is non-existent. So, that means we won't be able to really materially change things. And, Elon and the Doge branch of the government is well-intentioned, but I have a feeling they'll run up against a whole lot of red tape as they actually try to extract money out of the budget, and we'll see how effective they actually are. They could be entirely effective, and it still wouldn't solve the problem. I mean, we'll find ways to spend and add to the deficit, even if they take $2 trillion out of our budget. And even if they'd managed to balance the budget, it doesn't address the fact that we've already overpromised with Social Security and other unfunded liabilities that, we're not running surpluses, so we're not going to be able to like shrink the magnitude of those future promises into the future.
Yeah, and I think that's the urgency that in general we try to emphasize, is that, and anyone can verify this for themselves, of course, but the fact that this path exists and we have our whole future in front of us and can, basically argue that will be a very, very uncertain future, makes at least us, when we going into Bitcoin, act on the fact that we know that is the road and that is the end point of the road, basically, makes us act and move into Bitcoin. And I think that's in general part of what we're trying to communicate here.
Very well said. Well, we're just about at time, so maybe we'll wrap here. Just wanted to reiterate, thank you everyone for joining, carving out some time to spend with us today. And like I said at the beginning, to stay up to date with everything that Onramp is producing from a content perspective, future webinars and research, please sign up for our Research and Insights newsletter, which you can find just right on the homepage of our website, onrampbitcoin.com. And also, if you are interested in learning more about our products and services and how we can help you with your custody setup and all financial services that surround Bitcoin, please reach out and schedule some time to meet with our team. And you can find that on our homepage as well. That's it for today's session. Thanks everyone for joining. And thank you, Jesse and Bram, for leading the discussion.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.